Hey guys, thanks for joining me for this one. In this video, we're going to be going through some of the key earnings reports from last week in the stock market. If you like this type of content, please subscribe to the channel, like the video. Would love to hear from you in the comments as well if you own any of these stocks or own any other stocks that reported this week. But we're just going to get right into this one. This week was a pretty calm one from an earnings perspective in the market, but lots going on in the US banking sector that really put the overall economy in a volatile spot. Market went up a few days big as they rebound from significant down days, ending here on Friday in a bit of a drought as well. So we'll talk about that over some of the stock charts that we look at, but generally going to focus on some of the earnings. Monday, Tuesday, there weren't a ton of earnings that jumped out at me that I found interesting. So we're really going to start on Wednesday here looking at Adobe. Adobe reported what seemed to be earnings that were in line with expectation, but the stock really rallied hard on it, up almost 10% on the week, despite the volatility of the broader market. So really strong performance for this company. Their earnings came in at about $3.60 a share versus $3.50, and then revenue was spot on. So really interesting to see the company move this much. Must have meant that analysts thought that there was potentially more downside risk than upside. So when they did end up beating, it was a pleasant surprise. They also commented on their acquisition or pending acquisition of Figma, but they didn't really give any information one way or another since it's still a private company, but that is getting challenged and has the potential to be a pretty big distraction risk for the company. So 360 for the quarter. If I just, annualize that, this company's trading in the high 20s earnings. I've never been an investor in this company, but given it's a software company, high growth where they play, that's probably fair relative to other software high growing companies with really good track records like this one. Just looking back 5 years, a bit more volatile than I thought, but they've performed well. And then over the long term, this stock's really performed fantastically well over the last 10, 20 years. So that's the earnings update on Adobe. It looks like they came in, met and slightly exceeded expectations when it looked like investors thought there was some downside. Looking at their report here, it looks like they're in the process of buying back shares. So they bought back $5 billion, which is, let's just take a look at their market cap again. Yeah, that's actually very meaningful, 2.5% of the company. And it looks like they're going to continue to redeploy capital to shareholders through that. Other than that, just looking at some of their other financial reporting here, $17.6 billion of revenue on the fiscal. Look at those margins, only 2.1 billion of cost. So gross profit is like, 80 something percent. That's incredible. Then they obviously have a lot of operating expenses. So yeah, that's really interesting on a GAAP basis, making $10 a share. And then when you go to non-GAAP, that's where you get the $14. So looks like, I'm just kind of looking year over year here, 17.6 over 15.8 billion. So pretty strong top line revenue growth. Net income was pretty much in line. So net income between 21 and 22 didn't change very much. It was a lot going on in the economy last year. It's nice that they're seeing strong revenue growth. Hopefully they can turn that into more income as time goes on. Going back to our chart here, the other companies I was really interested in was Five Below on Wednesday. If you watch the earnings preview at the beginning of the week, I kind of thought that these stocks were priced for perfection. There wasn't that much upside left in them. And as we look at the stock this week, I'd say it just didn't move very much. So the market, I think, was slightly down. So that's probably in line with the broader market. Looking at their data a bit, they expected to be in the range of 525 to 576 on 3.5 billion, and they recorded 469 of EPS. So missed on EPS. and only 3.1 billion sales. So missed on EPS and missed on sales, unfortunately, for this company. Even with that being said, Wall Street still sees this company owning about making about 5.6 billion, $5.6 per share for this company. And just looking back at their stock chart, that's giving them a multiple of like 35 to 40, 30, high 30s, which is insane for a retailer of bricks and mortar goods, in my opinion. I know they play in a more defensive spot of retail, but I still think that's probably too rich for me. Now, going to the big winner of the week, FedEx jumped 12% on, I think we're on to Thursday now, 12% on Thursday. Really good earnings, really good profit results. You can kind of see here when we say really good, we're talking about relative to forecast coming in at $3. I think lots of the estimates were $2.50. You can kind of see their businesses, aside from services, which is nothing in terms of their revenue mix, was down across the board. EPS down, net income on an absolute basis down. So this is really a story of just very low expectations and coming in better than that. So revenue per package rose 11%, but daily package volume dropped 11%. So showed some pricing there, but then it all came out of volume. Shipments per day declined. We're seeing that low double digit come in again at 12%, but then revenue per shipment up 11%. So that seems to be the trend there, where volume on ground and freight down 10%, but they priced 10%. So it was net very nominal changes. But the $3 on EPS seemed to beat expectations at least. Let's look at the stock longer term. I'm surprised, given how much down they are year over year, that the stock's actually held up flat. If we look at the last 5 days, they got a jump from the earnings, but then they also increased their EPS target for the year, which they got another 8% jump today on after the fact. So from 13 to 14 to 14, 16 to 15, 20. So essentially a 10% increase in forecast here for EPS, solely based off of cost cutting, it appears. So they're not looking at driving, or they're not increasing their revenue forecast. They're just going to scrutinize every dollar and have a much more efficient cost basis, is what the CEO is saying. And investors really cheered that today, pushing the stock up 8%. And now, if they do $15 a share, that looks like, just doing some quick math, about a 15x on earnings for 2023, which isn't too bad for a company like this. So that's probably why it got the immediate jump, because the stock would have been priced, 13 to 14 times without the jump this week. And we'll see if they can deliver on those numbers. Next stock was Dollar General. Dollar General, I had a very similar opinion going into the week as Five Below. Great stocks, very defensive, but my gosh, have they been priced up over the last year or two. So in terms of how this one ended up performing on the week, down 3.5%. They looked like they missed on same-store sales, 5.7, lower than the 6.2 estimate. And then the revenue fell slightly short, 10.2 versus 10.25. EPS, couple pennies off. But the thing is, when you're talking about a company that's trading at a strong multiple as a dollar store, you really have to hit or over deliver to keep your stock price at the multiples that it's at. So made $3 on the quarter, probably trading somewhere around $20, 20 times earnings on the year. This one is a lot more reasonable than Five Below, in my opinion. But still, in retail, it's just a spot with a lot of consumer risk, a lot of other headwinds, whether it's like theft or whatnot, probably less of that in dollar stores, but not a space that I'm currently invested in. If I was, I would be Dollar General over Five Below, strictly based off of valuation. And then the last stock that we talked about going into this week was Williams Sonoma, and it was strictly based off of valuation. So you look at this company here, it's a flat on the week, trading at $7.8 billion. They do about $8 billion in revenue, I believe. So they're trading at under 1x revenue, and they make about 10% margin. So they're trading at 7x, or sorry, they make about $1 billion. So they trade at about 15% margins. So that means they're trading at about 7x, 7 to 8x earnings trailing. Now, the reason why this stock may not be getting a lot of love is because while they're trading at a good valuation, they have some issues on their business in terms of operating performance and growth. They had a 2% revenue decline in the fourth quarter, but they did end up beating on the bottom line despite margin pressures. So we can go into some of that here. EPS was essentially flat, plus 1% year over year at $5.50 for the quarter. And their overall revenue declined 2% to $2.45 billion. Gross margins down 4% from 45 to 41. But some things that were notable is that they actually launched a $1 billion buyback. Now, we hear a lot about billion-dollar buyback plans from big tech companies, but this is a $7 billion, $8 billion company. So they have a plan, or at least have approval to buy back up to 15% of the company in the next year, which can be a huge value creating element for the stock price if they actually have the free cash flow and the investment capability in terms of what other things may need capital to actually buy back that $1 billion of shares. The other thing is they increased their dividend by 15% to 90 cents. So what I'm seeing a lot of on Williams Sonoma, despite some declines, you can kind of see here declines of 6% at Pottery Barn. Growth of 6% at Pottery Barn, minus 10% at West Elm, minus 2.5% at their nameship brand, Williams Sonoma. They clearly think that they do not need more capital to grow the business, hold the business, and that's why they're, positioned to give a 3 to 4% dividend on the company while potentially buying back 10 to 15% of the stock. That's like returning in even not a bullish scenario, double-digit returns to shareholders just through capital allocation before or after investing back into the business. So this is just one that trades at a very cheap valuation. I can see it getting absolutely crushed if the economy turns down in a big way. So it's definitely a risky stock, one that I don't own, I've never owned, but I have on my watch list because if it gets hit down enough, maybe it's worth the risk reward of adding to the portfolio for a trade, even though I don't like to do too much of that. So that's the summary of this week. A lot less eventful week than lots of the weeks we've had over the last quarter, but thought I'd share my thoughts and kind of the results that I saw come through. If you like this type of content, please be sure to subscribe to the channel, hit the like button to show your support, and would love to hear from you in the comments. Thank you, guys.